it's the uncertainty that kills the market rather than the actual policy itself. And the trouble here is that the way of coming up with deals is very personality driven. So it's bilateral deals with President Trump rather than a rules-based form of an agreement.
Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. This month, we're pleased to welcome Bilal Hafeez, the founder and CEO of Macro Hive, a premier platform for global macro research and strategy that delivers accessible, actionable insights to both institutional and retail investors. Before launching Macro Hive, Bilal held senior roles at major financial institutions, including serving as global head of international fixed income strategy at Nomura. He's consistently been recognized as a top market strategist. With rising geopolitical tensions and uncertainties surrounding tariff policies, we're eager to get Bilal's perspective on what this means for the U.S. economy, global markets, and key asset classes, including, of course, private capital. So, Bilal, welcome to Private Capital Call, and it's going to be a great conversation.
Great. Thanks for having me on. I'm looking forward to speaking.
Well, you've been kind enough to bring me onto yours several times, and so at least we can do is start to get you onto Private Capital Call and get your insights. And the timing, I think, is particularly fruitful, just given what's going on out there. Your podcast, and I've seen, if not listened to on a daily basis, I see the topics that you cover, and I really encourage our listeners to take a look because you do literally cover the world, not just geographically, but also kind of strategically and from an economic and markets perspective. Let's go right into it and talk about the state of the world right now. We started 2025 in pretty good shape in the US, and I think globally. The headwinds that we had encountered in 2024 from concerns about inflation and the direction of interest rates and what was going to happen with the economy, were we going to get a soft landing? In fact, we did get a soft landing. The Fed engineered that. Interest rates had settled down, not back to where they were historically, but closing in on an average number, which made some sense, and below their highs. And inflation seemed to be settling in to kind of a 2-ish% level. We still had pretty good growth in the economy. And then all of a sudden, we had the tariff storm, which continues. We're on a little bit of a hiatus now as things get figured out. But why don't you talk a little bit about what you're seeing across the landscape, and then we can dig into asset classes specifically.
Yes, absolutely. Well, one thing I would say is at the beginning of the year, even, we were a bit concerned about how the market was pricing US growth, because the market, if you looked at the narrative we had amongst our investors around the world, the general consensus was that the US was doing incredibly well. Everybody was focused on the US. So there was this narrative of US exceptionalism. And whenever that happens, you always get a bit worried that too much is priced in. And people are underestimating either the risks on the US side or the opportunities elsewhere. And so we were already starting to get a bit concerned that maybe people were underplaying some of the risks in the US, which included residual inflation pressures, perhaps some headwinds for consumers. But those are kind of relatively small things. And then we felt like there were real significant chances that Europe and other parts of the world could see better growth than people were expecting. So already the setup before we went into the tariff storm was, in our view, a bit more balanced than many investors thought. But the Liberation Day Trump tariffs, I think for me, is a game changer in many different ways. And the important thing for me is you kind of have to step back and just understand the context of what this means for the global international system, because in many ways, the US, since the Second World War, has established the global rules of play. It's basically said that these are the rules of the road for trade, financial markets. And the US created the different organizations that are the guardians of these rules, whether it's IMF, World Bank, WTO. They set the rules for everything. And then there's the norms the US establishes, which are not established in these organizations. And I think what's happened on April the 2nd was that the US administration has essentially said it's the end of that regime. We're ripping everything up. We're going to start again. That system wasn't working for us. And you can argue whether it's right or wrong, but, there's been this unease in recent years about the state of the US, whether it's politically, socially, distribution of income, and so on. And so there was generally a sense that something had to be done. Now, the question is, what is the right thing to do? And people have different views on that. But what the US administration has done is to disrupt the global international order by using tariffs. So, number one, the scale of the tariffs, 10% as a base level and then higher for many countries, China obviously incredibly high. That puts US tariff rates at effectively the highest since the 1930s, and on some metrics, the highest in over 150 years. The second thing I think that's significant is the uncertainty through which the tariff policy has been implemented. So there was the initial announcement, then there was a walk back, and every day we're hearing stories about potential deals or non-deals and so on. And that, at some level, is the biggest problem here, because it's the uncertainty that kills the market rather than the actual policy itself. And the trouble here is that the way of coming up with deals is very personality driven. So it's bilateral deals with President Trump rather than a rules-based form of an agreement. Like normally when countries do trade deals, you basically have trade envoys who work behind the scenes for months and months and months. And then you subordinate it into WTO or a regional trade agreement, and then that's set for the next X number of years. With this type of arrangement, where you have a bilateral arrangement with a particular individual, there's always a risk that that deal could unravel in the next 6 months if the US decides to change the deal. Already, we've seen that President Trump, in the case of, say, US and Mexico, you undid the NAFTA deal in Trump 1.0, reinstituted USMCA, and now in this administration has ripped up USMCA by imposing tariffs on those other countries. So that's one of the sort of big challenges here. We're moving away from rules-based institutions to personality-led rules, which is a lot like, often, strangely, what happens in emerging markets. I've looked at emerging markets of the South American countries, Brazil, Mexico, Colombia. If you go to Asia, Indonesia, India, Pakistan, these sorts of places tend to be like that. And that introduces a big shock to the overall system. So for me, this is hugely disruptive to the global order of things. The parallel I would have is to the early 1970s, when Nixon took the US off the gold peg and then instituted a series of policies, price controls in the US, changed the whole global order. It's that type of scale.
Yeah. And even that had some precedent that it had been building, I think, since, if my history is right, since Bretton Woods. So there had been 3 decades of at least thinking about this issue before it was imposed. So I think you nailed something, and this, both of us travel globally, and we hear this from investors all the time. It's the uncertainty, right? Which clearly is not going to go away anytime soon. So I think, unfortunately, as our investors and CEO friends have told us, that uncertainty is much worse than bad news. We can orchestrate, manage around bad news. If we knew exactly what was coming at us, we can figure out a strategy to work around it. We saw that in COVID, right? That was the perfect example of the unexpected, in this case, pandemic, coming out of nowhere. March of 2020, 5 years ago, feels like 50 in some ways, feels like it's still going. And in that context, having to deal with all the after effects. It seems today as if we're seeing kind of similar after effects. I mean, supply chains, the cost of moving capital and goods across barriers and across borders now is really something that everybody is going back to the drawing board on. And as an example, one of my friends works at a large rating agency and had the unenviable task of rating the Panama Canal as a credit matter. And what was funny about that was I didn't even realize Panama Canal could borrow, but apparently it's triple B investment grade risk. Think about post-Liberation Day and pre-Liberation Day analysis of the Panama Canal. Very challenging. But if you extend that to every investor, every portfolio company, every corporate borrower, particularly the global ones, that uncertainty that you mentioned. So let's talk about the risks rather than the cause. So give me your views of recession. Let's deal with that first. Everyone's increasing the risk of recession, 30%, 40%, 50%, maybe it's 70%. How do you think about that, and what are you hearing from your sources?
Yeah, I mean, I think for me, it's very, very likely that we will have a recession. So I put the odds at, like 70, 80% chance that we get a recession this year. Now, there is definitions of recession: 2 negative quarters, jump in unemployment, how deep will it be? That's hard to say exactly, but I think it's a very, very high chance that we see a recession, not just in the US, but even in Europe and elsewhere as well, because after all, this is a global shock. It's not just the US that's suffering from this. It will be a global shock. And the transmission mechanism of this, one is if you look at some of the survey data that's coming out, which is a bit more forward-looking than the hard data, you're seeing consumer confidence collapsing. You're also seeing business confidence is also collapsing as well. You're seeing in terms of actual behaviors of companies, people are hoarding. They're building up inventories ahead of time, in anticipation of problems later, which basically means that you'll have this mini inventory cycle, a build up in inventory, and then the next quarter, people don't do anything because they have industry in inventory to destock. And so, in many ways, it's like a mini COVID, you could say. People have to kind of just wait, see, and then that just pulls everything back. So I think that's the first order. The other complication here is what will the Fed do in this situation? Because the Fed, will they respond to the growth shock or will they be worried about inflation? Normally, when you have a growth shock, the Fed just comes in, eases like they did with COVID. This time, will they be a bit slower? So that could make any recession a bit deeper. But generally speaking, this type of scale of tariff shock is just so large that it's hard to avoid a recession.
Yeah, and I think your point about the rate cycle is the next question, right? So the Fed, having orchestrated a soft landing, now is forced, it's like the balloon that has safely landed, right? And now the winds are picking up. And the Fed, if they increase rates to fight potential inflation from tariffs, risk further pressure, downside pressure on the economy. If they cut rates too quickly to stave that off, you could accelerate inflation, which they had successfully wrestled down to a 2% level. It seems like their current strategy is just to hold and see, as painful sometimes politically as that has been. But I do think that if they can, and I think they're predicting 2 rate cuts, Bilal, for the rest of the year. Yeah. And some, frankly, are predicting more, which that's fine. Who knows? I think that, my sense is that we're probably going to end the year 25 to 50 basis points either way of where we are today. Is that your sense?
Yeah, I think that's a possibility. I mean, there is a chance they could go more on the easing side if we have a recession. Recently, if you listen to Fed statements, they seem to be skewing more towards saying growth is the important factor, and we're kind of viewing tariffs as a one-off price adjustment. On top of that, we, of course, know that President Trump has been overtly pressuring the Fed as well to cut rates. The question is, how do you respond to that as the central bank? And I think, again, there's an interesting parallel to the Nixon period where Nixon was constantly pressuring Arthur Burns to ease policy, and he ended up easing policy back then, which ended up contributing to the stagflation that we had over the 1970s. So I think it's going to be a tough spot for the Fed. My concern is that if you look back to the COVID period, the Fed stayed dovish, even though we all knew it was a supply shock coming. And they ended up saying it's all transitory, and they ended up having to sort of hike quite sharply later. And there's a risk that something similar could happen now.
Yeah. So let's think if you play that out, what impact is that going to have on capital markets this year? That's a question that I get a lot. And then obviously positioning portfolios. So you have public markets. And again, we approach this, as I know you do, from an investor's perspective. We have institutional and retail clients globally, and they're always asking, how are you adapting to what is going on right now? So assuming that there's high risk of recession, obviously dealing with the challenges of tariffs, what are your contacts in the markets thinking about ways to be prepared?
Yeah, absolutely. I mean, there's a few things from a kind of a macro. I'll start with the macro, then go to the micro. From a macro perspective, most people are structuring their portfolios for an environment of continued uncertainty over the course of this year, with potential tail events, negative tail events. So you have to kind of position in a very defensive fashion. So that means that from a macro perspective, people have a bias to almost be neutral on, say, equities overall, and they might play tactically long short, but they don't want to necessarily be net long over the course of this year. So neutral bias on, say, equities, long things like gold and some safe haven markets like maybe the Japanese yen or the Swiss franc, to capture tail type events, an increased allocation to cash, just to be prepared for either liquidity events that you may need to deal with or opportunities as well, say distressed assets become available. So that's kind of the context. And there's some if you go back to the 70s again, not to continuing to sort of look at that period, but that's an interesting period where stocks essentially went sideways, gold did well, cash generally was the right thing to do. And you had high level of uncertainty, lots of supply shocks, lots of questions about institutions back then. You had Vietnam stuff, you had Watergate, there was this unease about do you trust institutions or not. So similar to kind of today in some ways. And that was a period where, some of these macro type hedges worked. Now, the micro level, there are interesting things that we can look at. One is which sectors will be less affected by tariffs. So one is if you look at the tariff exemptions, there at the moment, they seem to be focused on energy. So it seems like almost every country wants to exempt energy from tariffs. So it seems like energy will probably be a good play one way or the other.
Yep.
Semiconductors is a trickier one. But if you look at what the US and China are both doing in terms of exemptions, they seem to be trying to de-escalate the semiconductor war between the two regions because they're so integrated with each other. So that means that some parts of tech may actually not be as badly affected as initially feared. And then there's pharmaceuticals, which is a bit of a wild card here because the initial stance of the US was to exempt pharmaceuticals. We haven't had more clarity on that. So the deal, say, with India will be interesting. With Switzerland, it will be interesting to see what deals come up from that, to see whether pharmaceuticals get affected. So there are potentially some sectors here, energy, parts of tech, and pharma could potentially be relatively insulated from tariffs. Then the other side is services. Domestic services orientated. So, say the US, massive domestic services sector, that should be relatively insulated. Now, that won't be insulated from a recession, but at least it won't get affected by the tariff side. So then what you can do is you can play the business cycle trades within services, look for opportunities there. The other point I'd also make is, interestingly, if you look at small cap, mid cap companies in the US, many of them are less global supply chain affected than, say, the large cap guys. Large cap,
right,
have like Walmart, Amazon, are highly integrated to the global sort of cycle, whereas some of the small caps, even micro cap companies, which are very innovative, kind of fairly self-sufficient, they could actually kind of do relatively well within this environment. So I think there's two shocks you have to prepare for. One is the recession dynamic, which we kind of have a playbook for, defensives versus growth. But then there's the structural hit from the reordering of the global trade side, and you've got to pick the sectors correctly. The other thing that I would also say is I do think that internationally there's some really interesting opportunities. One is Europe is being forced to get its act together. It's being more active. Even the US has been telling Europe that they need to implement the Draghi reforms. Former ECB President Draghi put together a package of reforms that Europe should do, which is kind of like just a list of to-dos, and the US is saying to Europe, implement it. And those are things like reducing frictions within Europe, making them less regulated, and things like that. Japan is another one. Japan, I think overall has done a lot on the governance side, making everything more shareholder friendly. I think the economy over there is doing relatively well. So I think there's opportunities there as well. So I think there's pockets of opportunities within all of this, but one needs to be just very cautious around this all, because of this problem that we're moving away from rules-based to personality-driven policy environment.
So obviously, this U.S.-centric opportunity that you mentioned is something that's near and dear to our hearts and has been, frankly, the playbook for us for 20 years. I mean, we just kind of knew instinctively, being conservative credit folks, that the service sector historically, from a cycle perspective, has always been a little more friendly. The defensive sectors, healthcare, technology, software, logistics, the business services in general has always been more of a high free cash flow, resistant to downturns, versus chemicals, autos, energy, and so forth. So I think, and direct lending in general, particularly in the US, has realized over time, particularly those who've done that for a long time, that what you're saying makes a ton of sense. And so our portfolios have been, particularly coming out of COVID, have been geared toward that. And so the playbook is in place. And we've discovered, just looking at our portfolio, that the impact from a tariff perspective, to your point, for US companies has been fairly small and muffled, which is good. I think that let's talk about alternatives kind of as a macro matter when you think about illiquid asset class. And this is one area where, as I've traveled, I've found that globally, everyone seems to be in sync, whether it's Australia or Middle East or Far East, Canada, wherever. Investors seem to understand that the somewhat insulated benefit of being in alternatives, whether it's real estate, whether it's private capital, private equity, private credit, has been very beneficial. And they've seen it particularly in the last month as the public equities have just clearly been headline driven. And the conversations that we're having with investors really have accelerated, I would say, in terms of their interest in less correlated assets. And sometimes that includes some other, and I think we've talked about this in other contexts, other specialty areas within private credit, asset backed and so forth. Talk about a little bit about what you're seeing as private markets, I think, shown to be the growth engine, right? Because as public markets shut down, and by the way, in the US, the syndicated loan market and the high yield bond market have been shut down for 2 weeks. So, and by the way, our business is going fine. People are, we're approving deals pretty on a steady basis. I think that is a real positive in the current environment we're in.
I agree. And I think that also sort of reflects one of the weaknesses of public markets, which we've known since the global financial crisis. There's so much scrutiny on particularly bank balance sheets that they can't be seen to be doing things that could later on be viewed as being too risky. And so they become ironically very short term, very sensitive to the ups and downs of markets. When in reality, when you have a credit agreement with somebody, when you're lending to somebody, that should really be a long-term relationship at the end. I mean, the ups and downs, 5 basis points today, 10 basis points tomorrow, that shouldn't affect, everything. So I think that tells you something about the private credit markets. Moreover, I think with private credit in particular, there is some interesting structural differences with, say, the syndicated loan market, where you can be a bit more bespoke in terms of the deals that you do. There's less of a principal agent problem where, often the private credit originator and the company being lent to, there's a stronger relationship, between the two. Whereas the syndicated market, it's, many to one type relationship, which tends to be less robust, I would say. So there's some features of private credit that are quite interesting. And then also, if you just look at the amount of assets private credit has accumulated over the past year, it tells you that there's capacity to deploy for the right opportunity. Whereas with syndicated loan or high yield credit, that's very sensitive to volatility in the market. The perceived liquidity just vanishes there as soon as vol picks up. One side of private, I think, is probably more vulnerable is private equity, I would say, because coming into this year, there was a hope that there could be more exits for private equity. They've accumulated lots of companies that have been stuck on their books for longer than they had anticipated. So there was a need for exits. And there was a hope that, with a sort of stable stock market this year, there could be more exits, and then you could start to recycle, the cash there a bit. So I think that's probably an area that may not be as dynamic in this sort of environment as in previous cases.
Mm-hmm. So as we wrap up, I always end in these conversations by asking the same question. And so I'll ask you, what's been the biggest surprise? And you can use it for this year or, the last 12 months for you. And secondly, when we have this conversation 12 months from now, which, and we may have others between then, but in April of 2026, what will be the biggest surprise for people when they look back? So first, what's been the biggest for you, and what do you think will be the biggest surprise for?
Yeah, I mean, I think the biggest surprise for me, like everybody else, has just been the scale and the consistency of Trump's agenda. My thought would have been, we knew he was going to implement tariffs, but the size of them and how dogged he's been about implementing them, I've been surprised by. And the other thing is, like, what's the constraints on him? It seems like the market is somewhat of a constraint, but it's not as much as I would have thought. I was also thinking Congress maybe would also, act as a counterbalance, but that doesn't seem to be the case. So it really does seem like the executive has a lot of power, more than I would have anticipated. So that definitely is a surprise for me. In terms of 12 months from now, this is a bit provocative, but I think the surprise I think we'll all end up seeing is, I think the Fed may be a lot more compromised than we think, because they were so used to the Fed being very independent. But I think even under the Biden administration, there were signs that they were being influenced and they kind of play to the politics. And I think we may see more of that going forward. Yeah, so I think that would probably be the big one. And all of us have kind of, the last 30 years, have been used to credible independent central banks. And I think that would be the big shock for all of us.
Yeah, great. Well, this has been fantastic. And I really encourage our listeners to check out your podcast and the Macro Hive website, because there's so much going on there. And it's a great resource, particularly those of our global investors who are looking for other voices, other opinions in a wide range of topics, far beyond my level of expertise to accommodate into my brain. But it's a wonder, really, to behold. So thank you for that. Bilal Hafeez, founder and CEO of Macro Hive. Thank you so much for joining us on Private Capital Call.
Thank you very much.